Welcome to KBRA Podcasts, where we cover topical research discussions, industry commentary, and more. Stay tuned for insight from our knowledgeable team members.
Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by Karim Nassif from our Project Finance and Infrastructure Rating team, and Ken Egan from our Sovereign Ratings team here at KBRA. We'll be covering the topic of the growing impact of rising energy prices here in Europe. We will discuss the energy markets and how their elevated pricing levels may feed into the impact on companies, consumers, and sovereigns. You can find our latest report on the topic titled Growing Impact of Rising Wholesale Energy Prices on Europe and related information on kbra.com, where we regularly comment on everything from project finance to consumer lending. At KBRA, we actively monitor the markets and keep you updated with the ongoing impact of the events in Ukraine, Russia, and Europe on wholesale markets. Energy prices have been steadily increasing. Natural gas security and supply challenges will likely cause Europe's energy prices to remain elevated for some time, and this could have severe consequences for industries, households, and the public sector. As governments attempt to manage the impact, there have been European Union-wide and country-level calls for breakages in the link between gas and electricity prices, the introduction of windfall taxes on low-cost energy producers, financial support measures, and demand restrictions. These actions aim to help soften the financial blow to the private and public sector as Europe braces itself for winter when demand is highest. Today, we are going to dig into the impact of the energy price rises in Europe, as well as the credit implications of potential measures, both financial and regulatory. So let's start by taking a look at how we got here. Energy prices have been rising on the back of the conflict in the Ukraine. Karim, how did the market get to the position that it's in with regards to these elevated prices?
Thank you, Gordon. Yes, so there have been factors that have been driving natural gas prices up incrementally since January 2021. However, the Russia-Ukraine crisis, which created security of supply concerns, really drove what we see as a significant increase in natural gas prices. When we compare prices in January 2021 of euro 30 per megawatt hour, these increased to 350 euros per megawatt hour on 26 August 2022. And since June, these have increased 200%. Now, electricity prices have also been impacted as a result of the increase in natural gas prices. And the reasons for this is that the electricity prices are based on marginal pricing across the EU, which basically means that gas-fired power plants are setting the price for the electricity price because they are the last producer. Now, the energy suppliers in Europe are having to manage this increase in price by passing the cost on to consumers. And we're already seeing a number of suppliers pass on significant increases. If you look at Ireland, for example, Electric Ireland increased electricity and gas prices as of the 1st of October by 26.7% and 37.5% respectively. Customers are having to bear these increases, whether it's households or businesses. All of this is pushing governments as well as regulators to act.
Thanks, Karim. How have the governments responded to the current pricing? For example, there have been measures that have been introduced for example, in the UK, spending around 180 billion, and Germany just announcing that they could spend up to 200 billion in potential costs associated with helping out their individual economies. What other measures are proposed, and where do we go from here?
Yeah, there are different aspects to this. And I guess across Europe, most responses appear quite similar. Germany through this year has increased welfare supports. There's been VAT reductions, grant payments to lower income households, transport reductions, and recently gas and electricity price breaks have been announced. Further afield then you have Germany extending the use of its nuclear power plants into next year. But most other European sovereigns and even some sovereigns outside the region have followed suit in some shape or form. France reduced electricity taxes. This has been another common theme too. France was very quick to place caps on energy bills and boasts one of the more successful shields in Europe, keeping inflation artificially lower. France has the lowest inflation within the Eurozone bloc. Some sovereigns in Europe held off direct government funding as much as they could. For example, the Irish government credited energy bill accounts, hitting price rises at source, trying its best not to add to the inflation issue. Coupled with these, across Europe, then we've seen a whole raft of business-related support measures that follow similar lines, such as tax credits and energy bill subsidies. I think consumption reduction will be a big feature going forward as well. We can see certain incentives in Germany already whereby the energy user is encouraged to use less or risk paying more on what is deemed excess use.
Thanks, Ken. So what is happening on the regulatory front? Has there been any action from the various regulators across Europe?
Yes, sure, Gordon. I mean, I think Ken has just been through the important sort of government support measures. But on the regulatory front, it's important to note that these have included two major pillars. One is schemes to help the government actually raise funds, and sort of more sort of energy efficiency and energy demand control measures. The most important in the last few weeks has been the September 30 agreement at EU level to impose a revenue cap of 180 euros per megawatt hour on low-cost energy generating companies. Now, these are typically the sort of the renewable projects that we see out there that have very minimal cost levels, that are making a huge amount of profit and money because of the current prevailing prices out there in the market. And what the governments will do is to recoup some of the excess cash flows from these projects. And this will help them obviously support the households and consumers. The other measures have included sort of solidarity contributions. These are sort of similar to windfall taxes on profits. And these are going to be levied at the rate of 33% over the surplus taxable profit of companies in the oil, gas, coal, and refinery sectors. Now, on the energy efficiency side, there's been a mandatory 5% cut in electricity use during peak price periods, which was agreed at EU level on September 30. All of these measures are important. They're an important start in helping tackle the current challenges. What there hasn't been an agreement on as of this date is an agreement on any gas price cap. This is currently a hot topic that is being discussed at EU level. Some countries are in favor of capping the gas prices because of the impact of gas on electricity and the ramifications that it's having on the corporate infrastructure and other sectors in the economy, as well as, of course, households and consumers. What we understand is that there will be a set of proposals that will be tabled over the course of today, October 18, which will tackle potentially some sort of price corridor for the TTF, the gas price, and that will help manage the level of gas prices under various contracts in the EU. There's also some discussion about the EU acting as a club to help with procurement contracts with other energy suppliers and helping the EU sort of negotiate better agreements when working as a club, and some other measures also designed to help curb issues on the energy derivative side. What we need to note is that a gas price cap at the moment remains a very controversial measure, which some countries have concerns around because of the impact that that could have on the level playing field. When you look at the EU, it is competing with Asia, for example, when it comes to free-floating LNG cargo. This has been a big factor in the EU managing to wean itself off dependency of Russia. When we look today, the EU has reduced its dependence on Russian gas by about 20% over the course of 2022. And that's largely because of the EU's ability to attract this free-floating LNG cargo. The German and the Dutch concerns are that if a price cap is introduced, this might create adverse situation in terms of competition vis-a-vis Asia and make it much harder for the EU to continue to attract these freely floating LNG cargoes. The other concern is around the competitive environment in the EU What could happen if gas prices are capped? Will there be the same price signals that will help distribute gas to the countries that are most in need? Today, there is a market mechanism that allows gas to flow depending on certain price signals where it's most needed and where countries are willing to pay more. If that is removed, how will the limited amount of gas coming into Europe be distributed? Other concerns are around gas re-exports. What could happen to those if the price of gas is capped at EU level? Could certain entities be buying the gas and then selling it at a higher level and making profits? And the EU would then be subsidizing other countries by doing such a cap. So there are unintended consequences to a gas price cap, which are being raised by certain countries. It will be important to understand how all of this plays out as the EU tries to manage the various challenges ahead.
Thank you very much, Karim. Now, with all that as a sort of the backdrop of the current situation, how do we look at the impact of this on the sovereigns at KBRA?
Yeah, I think COVID left government budget deficits stretched and public debt high. And this latest energy crisis and the subsequent response will mean that the consolidation of these metrics could take a bit longer. We might yet have a European-wide response to some of these issues, but in general, it could be the case that as a result of geographic location, suppliers, and the nuances of how certain energy sources like natural gas can be stored and transported, economic performance through this energy crisis will likely differ across euro area sovereigns. I would take note of the way Europe as a whole has adapted to the shock, restructuring supply and building up storage capacity. And although risks remain, this helps mitigate the loss of Russian supply. I would also note, though, that for many sovereigns, years of ECB support through various quantitative easing programs, coupled with the low rate environment, means the cost of funding for many governments is still relatively cheap and access to liquidity on capital markets remains relatively healthy. Many sovereigns have taken the opportunity to restructure their debt and redemption profiles in recent years. Of course, the big impact could be on economic growth, with the possibility that some European sovereigns could enter recession. The rising cost of living, which drags disposable income lower, and high inflation, which erodes savings, economic activity could contract and demand could fall. Unknowns about new energy supply coming to Europe, unknowns about the war in Ukraine and the transition towards renewable energies, and even unknowns about the political agreements within the EU. All of this keeps the situation very fluid.
Thanks, Ken. Turning to you, Karim, how do we expect the impact on corporates, infrastructure, and projects going forward?
Thank you, Gordon. I think there's a big sort of difference between the short and the medium term. In the short term, we see the most sort of evidently exposed entities are the ones operating in corporate manufacturing in energy-intensive sectors, as well as energy suppliers and energy traders. Over the medium to long term, it'll be important to see how the macroeconomy evolves, but certainly entities exposed to macroeconomic cycles are going to be potentially at risk of earnings erosion, depending on the degree of collapse in consumer demand and disposable income. In the medium to long term, we could start to see sort of consumer good companies, airlines, other cyclically exposed sectors start to experience and witness impact. In the short term, it is going to be interesting to look at the performance of utilities. And I think that here there is a distinction between, in our view, the vertically integrated utilities and the energy generating companies, the likes of Equinor, Iberdrola, Naturgy, in contrast to the suppliers, the independent suppliers. We see, for example, that the generation companies, the integrated utilities, have been able to largely mitigate some of the impact of weaker revenues and profits from their supply business by having diversification internationally. So whilst caps are being introduced in countries, for example, like Spain and Portugal, if you are an integrated utility, you're still able to generate significant revenues, potentially from international activities overseas where caps haven't been introduced and where commodity prices are rising. By contrast, some of the suppliers, if you look, for example, at Germany, we see Uniper and other entities struggling and needing significant government support. In Ireland, for example, We've also seen Panda struggle as well. These are all suppliers that are impacted because of having to purchase at high wholesale prices and having to sell in the market at prices to the end user that haven't caught up with what is a significant increase in wholesale price. In terms of energy traders, there's also exposure in terms of cash collateral postings that they need to make. Again, to manage those cash collateral postings, significant funds have had to be raised. And much of this is coming also in the form of government support packages. When we look at the infrastructure sector, there's a distinction here in our view in that a lot of the infrastructure and project finance entities that we look at are actually able to pass on higher costs to ultimate consumers and end users and counterparties. So inflation pass-through is prevalent, for example, when we look at fiber infrastructure companies, toll roads. You could say a number of these sectors, including defensive sectors like pharmaceutical companies, waste management businesses, essential businesses, have been able to weather the storm. Where it's going to get interesting, though, is as inflation continues to rise, or if it remains at elevated levels, when you are providing a service to a public consumer, how easy is it going to be to expect the general public to pay what could be significantly elevated inflation levels? So this is an area that we're watching closely as the situation unfolds.
Thank you very much, Karim. Now, looking forward, what do you both consider to be the greatest risks in implementing further government support and enacting greater regulatory support for the sector?
Yeah, I think it would be interesting to observe how the market reacts to any further energy shield packages. For example, Germany announced their €200 billion package, and German yields actually moved lower initially because the government reiterated that it would not follow the same path as the UK, for example, and that it would eventually return to its debt brake and remain fiscally prudent. When Germany announced that borrowing would have to increase, markets viewed German credit in a very favourable light because the sovereign has very strong fundamentals underlying and a proven track record. Fiscal prudence, persistent surpluses both on the external balances and the government balances. German debt is the benchmark of the euro system. But on a slightly different note, what if some of the weaker members within the bloc decided to increase borrowing and up issuance in order to raise finances for an ongoing energy crisis? Up until this point, Italy's response packages have been paid for by windfall levies on energy companies and also increased government revenues arising from ongoing reform within government. But it's a question of time and firepower. With a massive energy supplier now gone from the market, the price will remain elevated for some time as participants bid up the energy market. And these shields might need to be renewed and extended. I would say, generally speaking, especially in Europe, we're having trouble weaning ourselves off QE. Now, QE seems to be embedded within the system. And remember, the ECB is still in the market and reinvestments will be there for some of next year as well. And while that does mitigate some of the risks associated with new energy shield borrowing plans, if there is that big issuance increase, liquidity conditions could potentially deteriorate, spreads could widen, the cost of issuance and the cost of outstanding debt could increase.
So, Gordon, from a project finance infrastructure and corporate perspective, it will be important for the EU to continue to successfully replace the Russian gas volumes, independent self-sufficiency, and that will require investment in infrastructure to a large degree. It's also going to require collective and aligned action at EU level that is effective and that doesn't lead to unintended consequences, such as, for example, certain nations having their utilities or their energy companies having preferential advantages over others. So a coordinated action will be necessary. And there will be challenges because the energy markets in the different EU countries are not identical. There are different supply-demand balances at play, different energy infrastructure. The marginal price, for example, in Italy is primarily linked to fossil fuels. In Norway, it's linked to hydropower. So there will need to be a good coordination. As Ken alluded, funding is going to be key here at government level, and how they coordinate funding operations will be key to ensuring that the response is coordinated and doesn't lead to unintended consequences. Also important will be that the focus on the energy transition continues, and that ultimately allows the transition away from gas dependence on Russia and provides Europe with a sustainable future from a funding and energy cost perspective.
Thank you very much, both. Your insights are very valuable, as always, on the current situation we are facing. As energy prices remain elevated, consumer and business cash flows will be negatively impacted as the energy price rises are felt this winter, with growing differentiation in pricing amongst the different countries. There is a growing risk of unintended consequences, as Karim pointed out, as measures are implemented despite their positive intentions to fund households and businesses through the current energy crisis. As discussed, utility providers and energy-intensive manufacturing corporations are the most exposed in the immediate term, with the more cyclically exposed sectors vulnerable to macroeconomic swings in the medium to longer term as a result of various different actions at a sovereign level. On the sovereign front, fiscal pressures are likely to be material for EU and UK sovereigns as they navigate best how to fund and support their citizens and businesses. Operational and funding alignment across the EU will be key in ensuring the effectiveness of new energy policies as the region moves to transition away from Russian gas. The dynamic situation changes by the day as governments, companies, and individuals adjust to developments in the market, and we here at KBRA are actively monitoring the situation. Make sure you are registered on our website, kbra.com, have subscribed to our podcast, and of course, are engaged with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Stay strong out there as we navigate through these challenging times.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Kroll Bond Rating. We'd also like to remind you that all of our ratings and research reports are available at kbra.com. Lastly, please share any feedback or ideas for future podcast episodes by emailing us at media@kbra.com. We hope to see you next time.